afternoon, folks. It's Dave Burrows, President and Chief Strategist at Barometer Capital Management. I want to thank everybody for tuning in today. It's been an interesting market over the last few weeks, and certainly over the last few months. I think a lot of people are following the news and trying to figure out how it is the market has rallied over 50% of what was given up over the course of the bear market from January 1st through the middle of June. Especially given the news flow of some slowing economic activity. And obviously there's very negative sentiment due to some of the geopolitical news. So the question is the rally for real, or is it a rally in an ongoing bear market? People are generally equally split on both sides, which makes it very difficult for investors to have confidence. So we're going to try and tear apart some of the data on the market internals. Take a look at some of the leadership themes and let the market try to tell us what we should take away by understanding some of the data. So I want to thank everybody for tuning in. Certainly, we should be in the middle of the summer doldrums, but there's been lots of news and lots of things to think about, and certainly the investment team at Barometer has been very busy. So just starting from the top, we continue to believe we are in a structural bull market. That started in 2013. And while there are lots of significant pullbacks along the way in a structural bull market or revaluation of equities, the pullbacks tend to be shorter. They can be very sharp, but they're over fairly quickly, and the market moves on and tries to look around the corner at what may be coming next. And it tends to be 4 steps forward for each sort of 1 step back, as opposed to what we see in secular or structural bear markets like the 70s leading up to 1981, or like the 1930s and 40s after the roaring 20s. When we look at the pullback as we've seen it, bull market's been going on now for 112 months. Market's made a cumulative advance of about 150%. Certainly there was a sharp multi-month pullback from the beginning of January into June. And we've certainly had a bounce off that. The reason that it's so important to try and keep this in perspective is what comes after bull market corrections. They are substantial, long, multi-month, multi-percentage point moves. And it's important to be there when the market gets going into the next leg of a structural bull market. We've been of the view for some time that the low we saw in rates in 2020 was a generational bottoming in interest rates. We know that rates move in very long cycles, both up and down, and there's lots of to and fro along the way. But what works during rising rates and a reflationary cycle is very different than what works in a disinflationary cycle. So it's important that we keep our wits about us and try to understand the big structural backdrop so we can make sure that we have exposures or don't have exposures to asset classes that either have a tailwind or asset classes that have a headwind. Be very careful not to get caught up in sort of a backward looking view. Certainly anything that was helped by falling interest rates had a tailwind from 1981 to 2020 with interruptions. And what worked during that period might be quite different than what works going forward. And certainly that was the case in the 1950s and 60s period of structurally rising rates. We know that the 10-year yield several weeks ago broke a downtrend that has been in place since the early 1980s. And we know that we thought that because the long-term moving averages were trending lower and continue to, probably there would be some consolidation to take place in yields once that happened. So as most people know, we took our short position off of the US bond market early summer, and we've only just actually re-entered a small part of that short position after yields backed off from 3.5% in a 10-year to just a little below 3 at 2.8%. Commodities, we believe, started a new structural bull market by starting to relatively outperform stocks like they did around the turn of the century and like they did back in the early 1970s. And once relative outperformance begins for commodities versus stocks. Commodities tend to do well in a reflationary environment. It tends to go on for a long time, but again, in fits and starts. And there's the Rji Index, which is the Rogers Equally Weighted Commodities Index, which we've been looking at for many, many months now, which month by month has been working its way higher. And certainly when the stock market corrected, by the time we got to the spring and the worst part of the sell-off, commodity prices did back off. In July, closing actually at the high end of the range after bouncing. And here we are in August, holding those gains. But you can see the long-term moving averages, the 200-month moving average, the 150-month moving average, and the shorter-term moving averages all have hooked higher, which probably means this can go on for a long time. There's a closer view as the RJI came down to the 200-day moving average and has held it 1, 2, 3, 4 times in a corrective period. Keep in mind, it's up over 20% year to date against a very tough market for risk assets. And despite the fact it had a 14% pullback over 34 days, relatively muted compared to stocks, the fact is it continues to be in an uptrend above the long-term moving averages. When we look at some of the components, here's Brent crude, similarly, up 37% year to date, has certainly pulled back off the highs, but again, still sitting above long-term moving averages. Now, we've talked about the fact that this has held up in price despite the fact that the US has been releasing on a regular basis significant amounts from the Strategic Petroleum Reserve. And we know that the inventory within the reserves has been dropping dramatically, and likely by October, the US will be forced to stop injecting new crude from Strategic Petroleum Reserves. But I thought maybe we could break out some of the underlying refined products to take a look at where things are from an inventory perspective. So on the first chart here, I show from the beginning of the year what the 2022 gasoline demand has been within the context of the previous 5 years average. And you can see that demand, frankly, despite high prices, has not backed off and is as strong as any year in the last 5 years, despite the fact we've just come out of pandemic. Now we compare demand to supply, it's a different story. Gasoline inventories are well below 5-year average and working their way lower, meaning there's lots of demand for refined products. Let's move beyond gasoline to diesel. Diesel demand solidly within the range that it's been in over the last 5 years. Here we are in week 32 of the year. But when we compare that to supply, again, supply continues to be way below the 5-year average. When we look at jet fuel, we know that actually jet traffic and demand for seats is now ranging above where we were in 2019 prior to the pandemic. So jet fuel demand is very strong. When we look at inventories, again, very low relative to the 5-year average. So whether we're looking at diesel, whether we're looking at jet fuel, whether we're looking at gasoline, inventories are low and going lower. So it may well be that at some price you would see a demand destruction, but as it stands, we aren't seeing that. Here's natural gas. Natural gas ETF UNG today closed at a new high. So natural gas demand is strong. Here we are in summer, and yes, there's been some warm weather in the US. This is nothing like the gas prices they're seeing in Europe, which are substantially higher. But this should raise concern about what may happen this upcoming winter when gas demand really heats up. So fixed income, we are not bullish on. We are neutral to negative. We are seeing strength in equities, that we're in a structural bull market, and commodity prices look attractive and are relatively underowned. That's an opinion. But we have to make decisions based on process. And we have 3 basic steps in our process. The first is to understand the backdrop, the macro environment. That's my focus as a macro strategist. We take all the investable universes we can focus in, various asset classes like commodities or fixed income or equities or real estate or emerging markets. And we try to identify from all of the areas we could focus in, which ones are seeing net new buyers put money to work. And we classify that as sectors or themes or asset classes that are seeing expanding breadth or improved participation across the universe within those groups. We then do a secondary set of work to try to identify specific securities that are good getting better, where fundamental characteristics are improving, and where price would support that view, fundamentally and technically attractive. Where we can find single securities that match up with sectors and themes and geographic regions that are seeing net new inflows of capital, that's where our portfolio should live. And this is an ongoing process. The third piece of the strategy is our sell discipline, which frankly is aimed at making sure that a little mistake doesn't turn into a big one. So we use stop losses. When we put on a new position, we identify a price below the price we paid, where we're going to go to the sidelines if prices drop and breach those levels. There can be lots of reasons to sell. It could be that fundamentally something's changing. It could mean that we get negative on the sector or theme. But the fail safe is to make sure we're using a stop loss to make sure our opinion doesn't get in the way of recognizing change in the market. But 80% of return comes from getting the asset class right and getting the right sectors within those asset classes. 20% of return is finding specific securities. We try to address all three. So let's just run through things quickly. Obviously, what we're looking for over time is expanding breadth. So as a cycle comes to market lows, often the strongest securities turn out higher first. And as time goes by, stronger and stronger securities, more and more securities join a rally. And that's a constructive market where breadth is expanding, more and more participation. We know late and in advance, often while the leaders continue higher, the weaklings start to sell off or lose their grip. And that tells us there isn't enough new money getting put to work, or there's enough money leaving that neighborhood where the risk reward levels have changed. And when that's the case, we have to tighten up our stops, raise some cash, and not put any new money to work in those groups. So the whole idea here is to focus on market leadership and market leadership shifts, to recognize change, new leadership as it emerges and old leadership as it recedes. And then finally, and most importantly, in the absence of leadership, have an ability to play defense, which we've really focused on when we get into a tough market. So we run these breadth models every day, and they try to highlight where money's getting put to work, where money's leaving, so we can make sure that our portfolios line up with what's actually happening in the market. So it's a very tactical approach. The portfolios change over time. Now, on June the 29th, our breadth models, percent of stocks in uptrends, long-term uptrends, had been weakening in Canada, had been weakening in the US, and had been weakening globally, and they had been for months. The shorter term indicators, percent of stocks above the 50-day moving average, were getting toward historic lows. In fact, only 2% of companies in the S&P 500 in the middle of June were trading above their 50-day moving average. And actually, that's one of the data points that, when it reversed, caused us to start putting money to work. Percent of stocks with positive momentum had been weakening. Percent of stocks making new highs versus new lows had been weakening. And percent of stocks trading above their 150-day or 30-week moving average, again, down around 20%, exceedingly low level. Well, let's fast forward to today. And as we sit, all of those look quite different. And so over the last few weekly updates, we've been talking about the fact that breadth has been improving. Percent of stocks in the NYSE in uptrends is about 62%. Percent of stocks in Canada in uptrends is about 45%. Percent of stocks in uptrends globally, as defined by a point and figure price chart, which is black and white, at 48%. What's more important is the percent of stocks trading above their 50-day. Now, the strongest market in the world has been the US market. In fact, the S&P 500 has over 90% of the companies or the constituents trading above their 50-day moving average. That in itself is a very strong signal that something's changed in the market. Percent of stocks with positive weekly momentum or upward trajectory. Over 90% of companies have positive weekly momentum. Percent of stocks making new highs versus new lows was persistently low until over the last few weeks has now moved up to just over 50%. And the percent of stocks trading above their 150-week or long-term moving average, Again, now over 50%. So we watch these daily, and should these start to change, we'll take action. But as it stands, breadth has been expanding, and there's no bear market in history that ever took place while this was the case. So now here we go with the S&P 500. S&P bottomed back here in the middle of June, made a higher low in July, and worked its way higher from there. 8-day, 21-day, 50-day moving average, trading all above those, trading above the 150-day moving average. But now we have a conundrum. We're coming into a declining 200-day moving average. Now, that poses an issue because often if the 200-day moving average is moving lower, it's going to pose some resistance to trade through. We're also running into a trend line that is in place since the beginning of the sell-off, which converges at the same price point. So this may be why many investors have said, this is a cause for concern for me. If the market was going to fail, or if we're going to roll over, and this was just a rally in an ongoing bear market, this may be where it's happening from. But this is probably the most telegraphed chart in the market, and everybody's looking at the same thing. My belief has always been understand what's happening underneath the surface. If this was being driven by only the 5 largest stocks as it was last year, that would mean breadth was narrow, and it would mean the market's more fragile. So how broad is this rally? Well, for one, we know that with this rally in the S&P, having traded above the last resistance point, is doing it on a broad basis. The US NYSE advanced decline line is actually outperforming the S&P 500, which means that the average stock is doing better than the market. That's the first thing. It's a broad-based advance. We know that if we look back at all of the bear markets since 1957, once the market recaptured over 50% of the decline, the bear market was over in every case, except for briefly, we pulled back after the low, after we'd retraced some in 2009. But that goes back to 1957. Use data to your advantage. When we look at the percent of stocks trading at new 21-day highs, this is often a sign that we have seen the lows and that the market is broadening out. And that's exactly what happened in May of 2020 as the market made its turn off the COVID lows. Well, this is a signal that's just flashed in the last week. Again, we're seeing 21-day new highs expand, and now a significant number of stocks well above there. We know that more than 90% of the S&P 500 companies are trading above the 50-day moving average. Again, we look at all of these occurrences that have happened over the last number of years. We go back to 1957. You can see there's a significant number where you got to over 90% of companies trading above the 50-day moving average within 50 days. And when we look at those occurrences, it may be over the next 5 days, you had a small amount of pullback, but the average was a positive result. Over 10 days, there were 3 occurrences where you had small pullbacks, one of them 6%. That's in 1988. 21 days or 1 month out, 2 occurrences where you had negative returns, but the average was 2.77%. But 42 days out, only 1 negative, and 60 days out, all of them positive. 126, all of them positive. 252 or 1 full trading year out, the average return 22%. These are all measures of breadth, and they are all pointing at the same thing. Money is getting put to work. Now let's look beyond the S&P 500, which is market cap weighted. Let's look at the S&P 500 value component. Well, we've talked about value over the course of the year as being leadership and likely to be for some time. Since the beginning of the year, you can see the relative strength line has worked its way higher. And again, over the last week, starting to strengthen again. And we know that the RPV, or the S&P Pure Value ETF, is actually up now on the year. It always matters, what is it that recaptures the losses first? That's where the strength is. Then, of course, you want to see when the market pulls back, how well things hold up. But at this point, you have to give the medal to the value index, which is back above beginning of the year. Let's look at market size. Small and mid-cap stocks, after relatively underperforming since the beginning of 2020, made a relative strength turn in April of this year before the S&P made a low, and has been strengthening versus the S&P 500 ever since. In fact, the Russell 2000 is trading better than 72% of all the companies in the S&P 500 in the last year. Importantly, now trading above the 200-day moving average and outperforming the S&P up to this point. Let's put them together. Mid-cap value. Well, it's even better. Now seeing relative improvement since the beginning of the year versus the S&P, trading better than 72% of stocks in the S&P. And again, very quick to recapture the 200-day moving average and looks to be moving back towards highs. So these are all just discrete pieces of data on top of the basic breadth data that we follow. But our job is to try to identify where do we try and take advantage? Where is the leadership? Do we need to change portfolios? Do our portfolios make sense given what has happened currently? These can always change. We always have to continue to measure. But the fact is, these are bearing out. It makes sense to be positioned. This is the longer term view of the Russell 2000, the mid cap 400 value index. And in fact, you can see that the bear market went on 470 days. So bear markets work their way out in time by going sideways for a period of time, or in price, or a combination of the two. And yes, through the early spring of this year, they had a sharp price decline, but it had been consolidating these gains off the 2020 bottom for a long period of time leading up to where we are today. So it looks to me as though we are getting very close to taking off to new highs in this area. Now, it's hard to imagine why. ISM data has been weak recently. Today, home construction was very weak in July, and new permits were even weaker. We know that the Empire manufacturing data came in at a significant miss today. So why is it the market handled that and didn't move lower? Well, we've been seeing concern about economic data and talk about recession now for 6 or 7 months. Investors have had lots of time to reposition. Valuations or price earnings multiples investors have been prepared to pay have been coming down. This is all backward-looking data, and it may be that this is going to continue to weaken for some period of time. But this is what the Fed wants to see. They want to see pressure on prices come off. We know that last week, when we looked at the CPI data and the PPI, or the Producers Price Index, it came in lower than expected. In the CPI data, we know that energy prices really came off. We also know that that goods prices came off, and the core food and energy made it such that CPI year over year was down. So, came in below what was expected. So inflation data appears to be backing up. Now, some investors may be making a case that the Fed ultimately will move to slow their trajectory of rising rates sooner than people expected. As it sits now, we're likely going to get another rate hike in the fall, but the net of it is inflation data is coming down. Now, when we look at positioning, we know that there's more shorted S&P futures than at any time since the pandemic bottom. And before that, the bottom of the correction in 2015 into 16 was about a 14-month correction. So investors are positioned. Yes, there's negative data, but inflation is starting to come off. We're starting to decelerate, and investors are very negatively positioned. Short S&P futures, very high cash balances in portfolios, very little risk taking. People in general are underinvested, and many portfolio managers underperforming on the year, which means they may have to chase the market as we go forward. We all worry about seasonality in August and September, But there's a lot of data here that suggests a lot of discounting of news happened in the first half of the year. And certainly sentiment continues to be exceedingly weak. Let's look at some other points of data. Credit spreads, or the excess return that a corporate bond investor expects to take the risk to buy a corporate bond versus a government bond. In the high yield market, these so far have crested at a 6% premium to Treasury bonds, well below where we went in the pandemic, well below where we went in 2015. This does not speak to a 2008-9 credit crisis. It's not to say it can't change, but there was very clear indication. If I had the 2008-9 data on this screen, they would be considerably higher than where we were in 2015 or 2020. Also, the investment grade credit spreads also coming in. Let's look at volatility. Volatility made its spike high in the early part of the year, and volatility spikes made lower high through the course of the year, and now back down in the zone where markets have their best returns, somewhere between 10 and 20%. So volatility not showing expectation for some big pickup in downside risk. Again, it's not to say these can't change, and we watch these daily, but as it stands, they continue to improve. So let's take a look at leadership. Just quickly, leadership has been energy so far over the course of the year. The XEG, or the Canadian Producers Index, up 39% the first 161 days, certainly corrected toward the tail end of the equity market correction. Traded held above the 200-day, now above the 150-day, and performing really constructively. Now, this is made up of oil producers and it's made up of gas producers. Certainly, the gas producers are behaving the best. Vermilion, a producer that sells a lot of its energy in Europe, getting European pricing, trading very close to the high, trading better than 99% of all the constituents in the S&P 500 over the course of the year. This is the third biggest position that the firm, along with Tourmaline, which is the number one position, trading better than 98% of stocks in the S&P 500 over the course of the last year. Both outperforming the XEG, the XOP, which is the US Producers Index, and certainly the S&P and virtually any other index. Outside of pure carbon energy producers, the clean energy stocks also continue to have a bid. We talked about the solar ETF last week. Let's look at renewable power as a source of return. We found strength in NextEra Energy, which is the company with the largest renewables portfolio of assets in the US. This is wind and solar. Also, Florida Power and Light, trading better than 92% of the companies, almost recaptured the highs. Northland Power, which has made a great turn off the 150-day moving average. This is wind power in Europe, selling at European power prices. And we could add Boralex in there too as a renewable, also trading very, very strongly. So the energy outperformance, we think, will have interruptions, but we think it's early days. And portfolio managers and individual investors are significantly underweight energy as a sector of their portfolio. Let's move on to financials. Now, financials are an important sector. And we came out of a lot of financials into the spring. I want you to notice that the relative strength versus the S&P bottomed in the middle of April. And while the market continued to make lows, held up better than the market into the market low, and has been relatively outperforming since then. This is the bank index in the US. We could look at the regional banks. We could look at insurance. We could look at capital markets, all of them outperforming the S&P. So we've been rebuilding our weight in financials. Now, we talked about having a barbell approach. We've had one portion of the portfolio in defensive assets, which were there for two reasons. One, to generate a return, price appreciation plus dividends. And then second, to be more defensive in the event that the market was going to sell off. Now, we know for sure that the consumer staples and utilities held up much better than the market through the decline. And in the event that we're wrong about the economy, have a lot less economic risk, but frankly, have traded very, very well. There's lots of different areas we could look at in consumer staples. We've talked about food companies, but let's look at some of the staples retailers. Now, today, Walmart reported their earnings. The stock was up 6%. They guided lower on their earnings in the beginning of July. Their concern was the quarter may come in weaker than expected. June and May had been below plan. As it turns out, they wound up reporting a number today that was in line with their original guidance and raised their guidance by 15% for the rest of the year. And it turns out inventories are in line. The value has gone higher because of inflation, but they don't have any over inventory. And the consumer was much better than they expected in the month of July. Also, Home Depot reported today. Now, we do have staples retailers in our portfolio. We don't own Walmart, but I think that we've got something better. George Weston's has been performing exceedingly well over the course of the year, trading better than 89% of companies in the S&P over the last 12 months. Has been working its way higher steadily, never broke the 150-day, barely broke the 50-day, and is now trading close to new all-time highs. Of course, Weston Foods has Loblaws and Choice Properties. And inside Loblaws, you have Shoppers. This is a company that's very predictable, been growing their dividend very nicely, pays us close to a 2% yield. And then there's Dollarama, one of the best run retailers in Canada, making new all-time highs, trading better than 95% of companies in the S&P. So the consumer for the basic goods continues to act well, and they benefit from the fact that inflation helps them to take a little bit of price. So between the utilities and the staples and healthcare, the dividend payers have been strong performers also. Again, up 6.1% on the year versus the S&P down double digits, moving higher nicely over the last few weeks. Dividend growth has been a key theme for Barometer. What's changing? Well, I think the biggest change over the last 2 weeks has been the emergence on a relative basis of the industrials. We know that many companies are planning on re-onshoring production in North America, and that's going to take a long time. But certain parts of industrials are performing particularly well. We're back above the 200-day moving average. And within this, we have many, many groups. One of the important groups are the rails. And you can see that CP Rail has been relatively outperforming the market since December. We're very close to relative strength new highs, and in fact, very close to making new all-time highs as they digest the Kansas City Southern. We talked about aerospace and defense over the course of the year, getting very close to new highs, relative improvement in relative strength versus the S&P since December. And in fact, now up 5.2% on the year. And within that, we talked a little bit about Northrop Grumman, which is making new highs, and Lockheed Martin, which is trading not far off of highs. So industrials, whether it's transports or whether it's defense and aerospace, both of those areas particularly strong. And then there are some other parts within machinery that look interesting also. Getting back to basic materials, we've seen rising relative strength now since the market bottomed in June. It was late to sell off. We've recaptured the 200-day moving average and the 150-day moving average. And again, this is a group that includes steel makers, includes chemical producers, it includes base metals producers, all of those reflationary assets that we've spent the last 2 years talking about. So whether it's the miners or whether it's the chemical companies or whether it's the steel companies, valuations within these stocks is very low relative to the S&P. In fact, as cheap versus the S&P as they have been since 2008. Moving on. Technology certainly seeing some improvement. Relative strength is a little bit higher than where we were in April. We're pushing up against a declining 150-day moving average. Certainly, there's some areas within tech that are acting better. We continue to be underweight. Some of the large caps have done well. Some of the mid caps less well. And we are now pushing up against the 200-day moving average. Communications continues to be weak, an area that we're sort of avoiding. And REITs continuing to make relative strength new lows. This is a group that's hurt by interest rates. So what you can hear is that things are broadening. Whereas in the middle of June, almost every sector that we followed had deteriorating relative strength and breadth. See, the small letters represent deteriorating breadth. When we look at where we are today, you can see that the average sector has moved up in breadth. In other words, every sector within this column has between 38 and 42% of stocks in uptrends. So breadth is expanding not just for some sectors, but almost for all sectors. So where do we sit? We sit with a more diversified portfolio than we've had in some time. Energy continues to be our most important sector. We're almost 4 times the market's weight in the S&P, and it continues to be an important contributor to returns. Industrials have come up from a month ago at 6% of the portfolio. They've garnered 6% new purchases. Financials have become 12% of the portfolio, specifically because we like the dividend and dividend growth attached. Utilities are at 11%, 4 times the relative weight within the S&P. Technology is back to a 10% weight, but still a significant underweight versus the S&P. Bonds have been used as a source of cash. Consumer staples are a defensive mechanism against tougher economy. Healthcare is about 6%. And the things that we have the lowest weights in, consumer discretionary, real estate, and communications, are the groups that we're being more cautious on. Outside of the US, well, there's really not much to get excited about. Outside of Japan, which is trading near highs, and outside of improving India, Europe continues to be a mess. At the lows, down 33% from June of last year, over the last year. Now, yeah, they've had a bounce, but on a relative basis, worse than the S&P. And until we've seen a turn in relative strength, this is a group that we'd avoid. In fact, if you're concerned about risk of a slowdown, this is where you would use a short. We know Germany is a similar picture. France is a similar picture. And why might that be? Well, certainly they have big structural challenges. When we look at what the cost of energy is forecast to be 1 year out by the market, it's a geometric increase in price. Today, one of the largest zinc smelters in the world announced they'd shut production because they couldn't afford to operate. What happens if that spreads to larger and larger industrial companies? We know that the Rhine, because of the drought, is down to something like 30 centimeters of depth, which means that a lot of the freight traffic that traffics through the Rhine won't be able to make it through. And of course, they're a lot closer to the conflict in the Ukraine. Emerging markets also continues to relatively underperform, so not much to do here. Again, at the lows, down 33.5%. So look, the S&P is at an important inflection point. And it may well be that the market has to chop sideways for a little while to digest some of these initial gains. But the breadth readings are irrefutable. They are improving over every measure, at the sector level, at the company level, at the market cap level. We're seeing breadth expand everywhere. And we know that while we are well ahead of the 50-day moving average, and it can come in, the longer-term data supports the fact that we're in a new bull market. And we'll look at data every day to say, is there something that refutes that, and be prepared to do something about it? You know, the S&P is 8% above the 50-day moving average, which is the widest spread since 2020. And we know that sometimes when that's the case, the market has some indigestion over the next few weeks. August and September are not the best months of the year. October actually tends to be, because once you get through the first week or two, market tends to strengthen. Second 2 weeks of October, November, and December to finish the year. We think it's possible a lot of the negative price action got drawn forward into the first half of the year, but we'll wait and see. If things start to weaken, we will get more defensive, but the last thing I'll leave you with is this. Every one of the S&P 500 industry groups is trading above its 50-day moving average. And we know that that corresponds with early stage new bull markets. So what do we have to look forward to? Maybe we've got a month or two of consolidation, but what comes after these bull market corrections is significant runs to the upside. We're happy with the way that we held up through the course of the decline. We're happy with the way we are positioned to go forward. We have half of the year left in front of us, and we look forward to trying to take advantage of it. But make no mistake, we will get defensive if we need to. So with that, if there's any questions, because I don't have Pam, I better take a look. Let me see if I can understand them. From one viewer, understanding you have a multitude of metrics when establishing a stop loss price for a particular stock. Can you give us an idea of how close the stop price is in percentage terms when stocks are in an uptrend, and how does it differ when you talk about tightening it up when conditions are less predictable? Well, at the risk of sounding a little bit obtuse, we use point and figure price charts, which I probably should spend some time on in one of these webcasts. Point and figure price chart was invented by Charles Dow back around 1900, and he organized a price chart in a series of X's when the market was moving higher and O's when price was moving lower. And you can see set points where there are inflection points where you go from being in a downtrend to an uptrend, or an uptrend into a downtrend. Some people might choose to use a moving average. I think there's too many people that focus on those. The point and figure charts, I think, are most useful. When our breadth models turn negative, we reduce the size of the boxes in a point and figure chart to make them more sensitive, but they are statistically significant price points where you go from the odds of making money being in your favor, in other words, being in an uptrend, to a very clear definition of a downtrend, which is where we're going to use our stop losses. Next question. Can you comment on the movement of cash from the sidelines or to the sidelines? What are we seeing from big institutions? Also, be great to have Diana on the next webcast so she can talk a little bit about trading. And I think that we'll do that for sure. You know, we do a morning meeting every morning, and each of the members of the team contributes a bunch of color on what's happening in the very short run and what we're seeing in the broader sense. Diana regularly comments on flows, and a lot of the flow data we get from her. We know that institutions have been incredibly cautious so far year to date. We know that futures positioning is very short the market, which could explain why the market has been able to absorb bad news, because there's very few investors who over-own equities at this point. We know private investors have not been willing to buy this rally. We know that at the banks, the flows into mutual funds and ETFs is exceedingly late. In fact, money's been coming out. And we know that cash positions in portfolios currently are very high. So I think positioning helps you to understand that investors spent months and months worrying about things like the Ukraine, worrying about things like inflation, trying to guess and position themselves for less risk. The only problem is that the early part of a bull market is where lots of returns come. And when you miss that, when you don't have a trigger to push you back in, like our breadth models for us, then it can be really painful, because once the market starts to rally, of course, now people don't want to buy it just before it has a pullback. So we'll have Diana on next week, and I'll get her to talk specifically about flows, and hopefully that's useful. Last question is an anonymous attendee asking about the possibility of Iranian oil coming back on stream. And I think that that's a possibility. I think there's a lot of hurdles to get over before that happens. And it would certainly help in the balance, but we know that it's likely we're going to see less Russian oil over the course of the year if some of the additional bans take effect. And we know that there's been very little by way of new spending on drilling. So there's not a lot of new production coming on even in North America. So we think that the market's going to be out of balance for quite some time. So with that, I think that we have answered most of the questions. If I didn't, if you'd like us to address anything else directly, don't hesitate to give us a call. Thanks very much for tuning in. I know that this is a time of year when people worry about what might be coming in the fall. We're watching very closely, but at this point, I have to say that the ball is in the hands of the bulls. And there is some pretty clear leadership in the market. It is broad-based and getting better. And so at this point, we're pretty fully invested, and we'll see where we go from here. So thanks very much for tuning in, and we'll see you again next time on the Barometer Readings webcast.